Hello? Mom, no. Okay, so mom. So you know that girl that I've been talking to? Yeah, the one that's okay, yeah, the one that's not from here. Yeah. She's actually her and I are gonna go on a show together. It's called 90 Day Fiance. Oh, you've heard of it. Okay, yeah, we're gonna go on the show. We think it might be a really good hello? Welcome back, ladies and gentlemen. My name is Joshua Castillo. Thank you for joining the channel. Today we're going to be hopping into Discovery Channel and Discovery Stock. Really, Discovery Inc. is really the company's name, and they don't own just 90 Day Fiancé. They own TLC, Food Network, HGTV. You're going to see in today's video. You're going to see why it's a great value play, or at least why I think it's a good value play, because I've been adding. I started adding. So let's hop right into today's video. We're going to do an introduction. We're going to do a financial, sort of the business model, strengths, risks, and then obviously we're going to talk about the merger that's upcoming. And then lastly, we're going to end with the valuation for the company, both post-merger and if the merger doesn't go through, what it's going to be worth today. So let's hop right into it and let's do this. So one of the craziest things that has actually happened this year, if you take a look at the stock chart, is at the beginning of the year, we had the whole Wall Street bets, crazy short squeeze, whatever you want to call it. We had that and it actually affected Discovery stock. You can see that on the stock price, it almost doubled or tripled from where it originally was before that. So one of the craziest things though is Bill Huang was one of the reasons you saw a giant crash down because he got margin called. I'll leave a link down in the description below if you want to understand the whole issue, but it really doesn't affect the core business. I just feel like if you look at the stock chart and you're wondering why the 52-week high is so high, that is why. Now, as for the business model, why Discovery is what it is, it's a global media conglomerate. They own a ton of different channels across a ton of different countries. They actually have 3.7 billion cumulative subscribers according to their 10Q, their most recent one at least. And on top of that, they're trying to get into Disney's pluses and Netflixes and all these different pluses and ises that we have. They're trying to get into that online streaming business. And with Discovery Plus, they're doing just that. Now, this direct-to-consumer is obviously higher margin. You're going to be able to make a lot more money, and you're not going to have to worry about paying anyone licenses or anything like that. You control your own media. So one of the great things is that because of their business model, their advertising from the cable business has already paid for everything that they're going to be putting on this Discovery Plus brand and this Discovery Plus platform. So with that being said, everything's already paid for. So they're basically double dipping into this content and reselling it, repackaging it, and being able to advertise it to people for them to sign up for and be able to go and watch all your seasons of 90 Day Fiancé and Food Network and all those kinds of things. Now, with that being said, they have 20 million subscribers as of Q3 2021, and that is going to be the end of September. So with that being said, there's still a lot of room for them to grow, and they really think that they have a lot of upside, and you'll see here in a moment why we think as investors there may be a lot of upside to this company. Now, one of the biggest things to note is that they are trying to merge with Warner Media, but from their core business, they're going to be bringing over Discovery, HGTV, Food Network, TLC, Animal Planet, the Cooking Channel. There's a bunch of other channels on here that I honestly don't even recognize. DIY, and then obviously I'm going to pop up a bunch here so you can at least see them. There really is a ton of channels that they have access to and that they make content for that I honestly didn't even know existed. The way that they break apart their segments is you have the USA and you have the international brand segments in terms of their revenue. Now, underneath each of these segments, they have the advertising. So these are going to be things like any sort of ads that they run based on their markets or any sort of channels that they're running or the international versus domestic. These are all things that will affect it, but just think when you think of advertising, think of the space that they sell in between when the actual show is running. That is going to be the advertising space that they're selling on their channels. On top of that, you have distribution. Now, according to their 10Q, the distribution revenue consists principally of fees from affiliates for distributing our linear networks, supplemented by revenue earned from subscription video on demand content licensing and direct consumer subscription services. So essentially what that means is that it's just licensing fees that they earn by licensing out their shows to other companies and other brands, and also their direct consumer. So this is really the revenue segment that you want to pay attention to if you like the story about them growing out their direct consumer brand in Discovery Plus. And I personally think that honestly, one of the best things about this company is that they're going to be venturing into this Disney Plus, Netflix Plus era. And if they do so at a good pace, they'll actually be able to be probably one of the big players, I think, in this space because they have a huge hold and their channels all are ranked top in terms of ranking against other channels. So I think that having this big pigeonhole basically on a bunch of viewers is going to be huge when they go to push people onto their direct-to-consumer platform. Now, as far as the revenue goes, you're going to be seeing that the revenue is really kind of flat. There is a big jump from around the end of 2017 into 2018, and this was because they acquired Scripps. So if you're looking at this, don't think, oh my God, they found the magic pill. All of a sudden their revenue jumped up. It's really because they acquired Scripps, and their revenue from Scripps is now on Discovery Inc.'s books. So if you're looking at that, that's really the reason why you saw that boost in revenue. But for the most part, it has been flat in the organic Discovery Inc. business. And you're going to see a little tiny tick up over the next coming quarters because of the fact that they're using that higher margin Discovery Plus business to boost the revenue, get sales, and ultimately get to the bottom line and add to their net income via that business. Now, some of the financials that you're going to be paying attention to, obviously, as I just mentioned, the revenue has been growing for TTM, so trailing 12 months. As of Q3 2021, we have $11.89 billion on the top line, and then their profit margin has been floating over the last couple of quarters and the last couple of years in between 12 to 15%. Honestly, for a business that is only making money off of ads and they're selling TV channels and they're sending people all over the place, this is great. Like profit margin is great. The fact that they even have profit is in this day and age is really, it's amazing. So I really like the idea, and I love that they have profit. Also, one thing to note, the way that their channels are structured and the way that they follow, rather than very produced and scripted TV, they have a lot of live TV, and this is usually a lot cheaper for them rather than having a whole scripted show like you're going to see with HBO Max. So here you can see I have their gross margin, operating margin, net margin for the last couple of quarters. See how it's been bouncing. Also, one thing I wanted to mention was that there are 3 different kinds of stocks that we're going to be taking a look at here today. I'm going to be focusing on the C shares, but there are 2 other stocks, and obviously there's probably a couple other preferred shares that they have. But DISCA, that's their A shares. DISCB is their B shares, and DISCK, that's the one I'm focusing on, is their C shares. So for DISCA and DISCK, they sell at a tiny bit of a the C shares sell a little bit below the A shares. And the reason being is that there are voting rights for the A shares, but not for the C shares. But you're going to see why here in a moment, why I have decided to go with the C shares rather than the A shares. So as far as the enterprise value to EBITDA, it's going to be around 3 to 4, depending on when you look at it. When I pulled this for my for the article that I wrote, it's about 3.5. So lastly, their current cash is for Q3 2021 is at about $3 billion, and then the total debt is at about $14.79 billion. So that's a pretty big thing to mention. Their total debt being $14 billion, that's above their current market cap. And you're going to see why that's a huge risk for the business model if you don't already understand why that debt is such a big risk. But we're going to hop into that in just a moment. So as far as the industry goes, though, one of the things I wanted to note is the fact that the US sort of pay TV, again, okay, we're going to wait. So one of the biggest things as far as their industry goes is you have to focus on 2 separate industries when you're looking at this company. The first industry being the sort of cable TV, traditional TV, and selling that side of the business and the advertisement that goes behind that. Next, you have the direct-to-consumer, the Discovery Plus side of the business. So as far as the cable TV side of the industry goes, one of the things that I found from Grandview Research is they actually expect the cable TV, or they call it the US pay TV market, but this is the sort of United States TV market. They expect it to go down by about 3.3% per year for the next, I don't know, 7-8 years until 2028. So that's something to note as far as the business side of the cable TV goes. But as far as the Disney Plus side, one of the things I found was that Fortune Business Insights released a report where they expect the video streaming market, so that's kind of just everything online streaming market, they expect this to reach an $842 billion valuation with a 12% CAGR, so compounded annual growth rate. And this, I believe, was for the next couple of years. So this is a pretty big market and pretty big TAM that we're getting into. And this total addressable market is really about how big of a slice can you get, and then can you grow that slice. And you don't necessarily need to take away market share from other players, but just growing the pie as a whole and holding your market share where it is. Because at the end of the day, as long as you can grow the pie and keep the slice that you have or even grow it, obviously going to do way better on your sales side and your net sales side. So that's always great. So some of the sort of streaming platforms that they're going to be competing against, you have Apple TV, Amazon Prime, you have Roku, Netflix, Disney Plus, Fubo TV, Peacock, and there's a bunch of others like Paramount Plus that are all coming out now. So it's going to be interesting to see how things get consolidated and see who buys what. You're going to see today why HBO Max and Warner Media and all that might go under Discovery Inc. into a new company. But just note that as far as the industry goes, cable TV is slowly dying out, but the streaming, direct consumer side of the business is growing at a rapid pace. So if they can keep pace with this, they're going to be golden. Now, if you see me keep looking down for this piece, it's not all up here. I have it written down in the article. If you want to look at the article, you can look down below. It's on a Substack article. But one of the key things that was announced this year for Discovery Inc. and why I think that this is more of a buy than I think I would have originally put on it is the fact that we're going to be merging with Warner Media. Now, Warner Media is actually going to be spun off from AT&T. They currently own it, and they've decided to create a deal where they estimate by mid-2022, they're going to actually merge Discovery Inc. and Warner Media together and create one conglomerate called Discovery Warner Media, or Warner Media Discovery. Whatever it's called, they could have came up with a better name, but I understand why they kept both their names in the title. Now, as far as what the benefit is in all this, HBO Max has a ton of content, a ton of hours of content. The great part about their content is it's not like Discovery's content. So they don't have the TLCs, HGTVs, the Food Network, DIY channel, cooking channel, all that stuff. They have more scripted shows. They have more series and things that people really hang on to, like Game of Thrones, DC. They had a ton of other channels as well. They have, obviously, you have the Warner Brother Media, just conglomerate itself. You have TBS, you have HBO, you have TNT, you have Cartoon Network, CNN. One of the craziest things is that they'll actually have control over, if they can get this merger to go through, is they'll actually have the MLB, NBA, and NHL, March Madness. Those are humongous, just broad channels that capture all sorts of views. And right now, all of Discovery's channels are very female-heavy demographic, while HBO's channels, some of them have a mix, like HBO has a mix, but you have a lot of the more male-dominated channels, like the sports channels, as far as the demographics go. So you can really sort of marry these two without actually cannibalizing either business. So that's why I think that this is one of the great opportunities that they have to build out this business model. And through the merger, they should be able to do this with great ease. Now, as I mentioned before, the Discovery side, Discovery Plus, has 20 million subscribers, while HBO has 69.4 million subscribers. So you can see that the combined total probably be around, I don't know, 90 million. Now, how many people own both? We're not going to be sure until the merger actually goes through, but they do estimate that they don't think that there will be too many people that will sort of jump for one or jump for the other and not have both, because it doesn't really, one doesn't take over the other. It's not like owning Netflix and Discovery, where you kind of have access to the same thing, or Netflix and HBO, where you kind of have access to the same content. So that's one of the great parts, and management was very easy to point out that, again, they're not going to cannibalize each other, so there's nothing to worry about there as far as the management goes. Now, as far as the financials and what it all means for the merger, one of the great things is that Discovery's whole entire business is going into this sort of merger company. So the way that this is going to be split out from the spun out business, so from the conglomerate or the combined merger business, Discovery Inc. shareholders are going to get 29% of that business. So I believe it's under the ticker WBD. I think that was a ticker that they came up with. And then AT&T shareholders are going to get 71% of that business. So the way that the stocks are going to be handed out is that all of the stocks, so DISCA through the C shares, those are all going to merge into one WBD share. And then AT&T, I don't know if they're going to be doing a dividend or a special spin out the way that they're going to do their own stocks, but I'm focusing on Discovery for today, on the Discovery side of the transaction for today. Now, one of the great things about this is the fact that DISCK is selling at a slight discount to DISCA. So you're at least guaranteeing that whatever the price is, you get a tiny bit more premium on your shares because now they're going to be one and you'll have voting rights on these new shares. So that's why I'm buying into the C shares rather than the A shares, but I understand some people don't understand it, or it may just when you buy in, whichever one's cheaper at the time is the ones that I would look into. Now, the way that this is going to work, though, is, again, Discovery is going to contribute all of their equity and contribute all of their debt. So they're going to have about $15 billion in the Discovery side, and AT&T will receive a $43 billion cash payment, and that $43 billion will go towards the debt from the Warner Media side. So really, you'll end up with somewhere around 47 or 57 to around $58 billion in debt. And they recently, their original estimate was around 5 times net leverage. So 5 times EBITDA, I believe, was the net leverage that they were expecting. And now they're expecting 4.5, and they're trying to get that even down lower before the merger. So their ideal goal of the net leverage is 3, but they seem to have a good attitude and a good idea of how they're going to get this debt down, and that is really the key component because the debt is really the scariest part of this entire deal. Now, the merger is expected, once it goes through, to have a top line expected in 2023 to have a top line of $53 billion or $52 billion in revenue, and then they also expect around $14 billion in EBITDA. Now, again, these are all estimates. These are all pro forma. There's obviously, we're going to have to wait until we see the business go through, but if you trust the management team, if you believe that they can actually do this, this is going to be a good buy-in time, especially while the stock is trending lower and lower. At least it's something I've been buying into, but it could be, depending on your own due diligence, a good time to buy as well. Now, another thing to note, they're also targeting about $15 billion in direct-to-consumer related revenue in 2023. So you're going to see that as this business grows more and more, and as they merge cost synergies, and that's kind of one of the key components that the management team of Discovery is mentioning as well. They want to merge these costs so that way there's not a bunch of costs and expenses going into this, and that way, they probably have the management and the systems and everything already set up. They just need to merge the businesses properly. So the last thing that I wanted to mention is that the Popular Investor actually did a breakdown of this, and I'll leave wherever the card ends up, I'll leave a link to his video, but he actually broke down where and how this merger is going to be going through. So the first thing to note is that, and this is straight off of his video, I'm not going to try to act like this is mine, this is off of his video. He did a great job explaining this, so that's why I didn't want to try to over explain it or anything like that. But basically, the debt is going to be broken out like this. You have Discovery that has $15 billion in debt and $16 billion in equity, and then you have HBO, which has $43 billion in debt. These are the things that we know, and these are the things that we understand. So taking those assumptions, you have an enterprise value of $74 billion. From there, you kind of can get an idea of where all of this is going and how we're going to be able to do this. So the ownership, as we mentioned before, is going to be 29% to Discovery and 71% to HBO, and you can see how the enterprise will break down into Discovery's favor. So from there, they're estimating that, and they're guiding that they want a 3 times net debt to EBITDA ratio. So from that, you have your revenue at $52 billion as they gave, and he estimated that, I believe it was 11, I think he had it at 15. I don't think that I think the estimate will probably be lower, the multiple at least, that is used. I think it's lower. I think 11 to 10 will probably be more accurate. Again, we're being conservative. So But for now, I'm going to show you guys 15 because this is what he did. If you want to play around with it, I leave a link down in the description to the article, and you can actually go in there and mess with it if you want to. So he estimates that net debt to EBITDA margin at 32%, 25%, and from there you can see how this is breaking down. And that leaves you with $49 billion in debt and $39 billion in debt. So the equity valuation, when you break this out, so basically under the 25% margin, you have a $45 billion equity valuation for Discovery. Under the $32 billion, you have $57 billion valuation for Discovery. So ideally in scenario 1, you have 181% upside. In scenario 2, 259% upside. Even with the 11 multiple rather than the 15, you still had almost 100% upside in the second scenario. So that's why I'm saying do this in a conservative way. Don't necessarily put the highest multiple you can think of, and you'll be a-okay. So just jumping through the strengths really quick, if you haven't already, if I haven't already convinced you about the strengths, they own 4 of the top 15 primetime networks for Discovery. And these are all, again, they have a heavy female demographic in these channels. So I think that's why it's a great thing to get into and why HBO Max will be a great complement to their core Discovery business. And then obviously you have the subscriber growth. They grew from 0 in the beginning of the year to 20 million as of Q3. So 2021 has been a great year for Discovery, but their stock price is obviously not going to show that. So the last thing is their strength. If this merger goes through, it's going to be great for the core business. I think that there's a lot of cost synergies. I think that there's a lot of management that will be able to unlock value. It just may take some time. So if you're getting into this, understand what you're getting into. Do your own due diligence. They released the S4 for Discovery, so you can read the merger information. It was like 700 pages long. It was very, very, very long. So the last thing that I really want to get on is the risk and where I see this going. So you have $15 billion in total debt, or just below $15 billion in total debt, and their free cash flow as of Q3, that TTM, is around $2 billion. So it's almost 7 years to pay back, and that's assuming that their free cash flow doesn't change at all, and this is just for the core business, that their free cash flow doesn't change at all, and that they just put all their free cash flow into their debt. It takes them 7 years to pay all that back. That's a big risk. I really do see that as an issue, but if you're okay with that and you're okay with the risk and you believe in the management, they have handled debt like this before, I think that there's really an opportunity for them and for the value that we're currently seeing today. But again, if you want to see more information, look at the article that I linked down below. And then obviously the second risk is just the merger not being completed. I don't think this is a risk as so much for the core business as much as it is for the stock price. The core business may take a hit initially. I think that the direct-to-consumer will kind of build itself out on the Discovery side. But obviously, if the merger doesn't go through, Discovery's stock is going to go down in a big, big way because a lot of people are baking in that this merger is going to happen and that the stock isn't running to 0. So I really would pay attention to this if you're going to get into this early. And then the last thing we're going to be getting into is my discounted cash flow and what I am actually looking at. So the first things first, you're going to see that I have a bunch of stats: the current outstanding shares, current revenue, free cash flow, net debt, all that good stuff. Now, I currently have the market cap at $13 billion and it's at $27 for the share DISCK. It's obviously dropped significantly below that as of today when I bought my shares. But this is when I wrote the articles at $27. So you'll be able to see kind of an idea of what I was working with. So one of the things on this screenshot is that I use the Everything Money's method of the worst case, base case, best case, and they use net income and free cash flow to sort of give you an estimate and an indicator of how far off are you as far as the fair value for this business. Now, my net income at the base case and my free cash flow at the base case, I have about $30 to $38. Even for the worst case, I have $21 on the net income side, and then for the free cash flow, $25. As of today of making this video is just under, I think it's at 2250, 2260, somewhere around there. So obviously this has moved way down and my margin of safety is increasing more and more. And there you can see, these are my assumptions. Obviously I have the share change, revenue growth, profit margin, free cash flow, PE ratio that I expect at the very end, and the price to free cash flow ratio that I have at the end, and then discount rate that I used. This is gonna net me $15 per share. That's kind of my cost of equity. But again, this is so much debt on the balance sheet right now, and I take the debt out of my DCF. That's what that $15 is. It's after the debt's been paid. So I think that, or it's after the debt's been taken out. So I think that I know that $15 is pretty low from where the current stock price is. But if my estimation is correct on the everything money, I'll call it indicator up top, then I think that this is a buy for me. And that's why I went ahead and started my position today in Discovery. So my plans for the future, I'm going to keep watching this merger. It's really big that I watch this, and it's really important that I watch this. I read through the S4. I'm going to keep reading through the different quarterly reports, and if any sort of earnings calls or presentations come out, I'm definitely going to pay attention to that too, and I'll definitely update y'all. So the last thing is you need to watch the leverage. I think out of everything, the leverage is the biggest key component of this investment. If you're going to actually get into this company, the leverage is something that will take down a business if it's done incorrectly, and it'll take down a business if we have a downturn. So if you have a lot of leverage on your balance sheet, that's really a huge risk. That's why I'm not going to make it into a huge position. I think I'm going to make it 5%, even if that. It's not that I don't believe in the business. It's, for me, the leverage is scary. So unless we get to see way smaller valuation on this, I'm going to keep this at around 5%. So the last thing is that, again, watch the leverage, watch the merger. If you believe in the business, this may be a great time to get in. If you're not comfortable with buying in before the merger, make sure you take some time, look at the due diligence, look at your own due diligence, and then go through the 10Qs, 10Ks of both AT&T and Discovery to see if this merger makes sense. If the merger does go through, make sure that you actually, read into this, look at the management team, see if you believe in their ideas and things that will get the net leverage down. And that's pretty much it for today. I hope y'all enjoyed the video. Sorry for making this a little bit long. Just want to kind of get my ideas out there, see where you guys are rocking. Let me know if you have any feedback down below, and I'll hope to see you in the next one. This is me, Josh Castillo. Hope you have a great day.